Welcome, Duke alumni and friends, to this session of the Duke Alumni Forever Learning Institute, an interdisciplinary education program organized in a set of thematic courses. I'm Jo Supernaw, the Director of Academic Engagement with the Lifelong Learning Team and Alumni Engagement and Development. And I'm your host for this evening. Thank you for joining our program, The Economy of Climate Change. And this program is actually part of our theme, Climate Changemakers, which is inspired by the Duke Climate Commitment. I'm incredibly honored to introduce our moderator for the discussion today, Brian Murray. He is class of 87 with Master's of Science and class of 92 for PhD with Duke University. He's the interim director of the Nicholas Institute of Energy, Environment, and Sustainability and a research professor at the Nicholas School of the Environment. Welcome to the Forever Learning Institute, Brian.
Thanks very much, Jo. I really appreciate it. And I appreciate being invited to moderate this panel this evening. For several decades now, my own work has focused in some way on the economics of climate change. First, early on, by understanding the economic effects of climate change on forests, and more recently on the design of economic instruments to induce low-carbon energy adoption. This work over these years has mostly involved directly engaging with policymakers and business leaders to try to connect and help them make better decisions with a team of other people as well. I'm also happy to be co-leading the Duke Climate Commitment effort with my colleague, Toddy Steele, Dean of the Nicholas School of the Environment, and Tavy Capps, Executive Director of Sustainable Duke. Now on to our topic. Some of you may not immediately think of climate change as an economic issue, but an environmental one. Yet the environment and the economy are totally intertwined. You can't separate them. Economic activity generates pollution as a byproduct. Pollution alters the environment, which itself has an impact on the economy. This is what some refer to as a circular economy concept. So what are the environmental and economic foundations of climate change? Well, it starts with the accumulation of greenhouse gases like CO2 in the atmosphere. These gases come from activity like energy production, industrial processes, transportation, agriculture, and land use change. The accumulation of these gases disrupts our global climate system in a number of ways. The higher concentrations trap more heat from the sun. That's why they're called greenhouse gases. And this raises global surface temperatures. Not only is something that we would expect to happen, we've observed it happen since essentially from pre-industrial times, we've observed an increase in global surface temperatures of about 1 degree C. This can lead to rising sea levels, disruption in hydrological cycles, precipitation, and severity, which can lead to droughts, fire and flooding in new places and at different durations. This can cause species migration and extinction and cause human migration. In fact, later this week, I'll be in D.C. at the Duke in D.C. office, helping kick off a climate migration project coming out of the Sanford School of Public Policy. More CO2 also acidifies the ocean, which can diminish the abundance of carbonate ions, which are important building blocks of structures such as seashells and coral skeletons. All of this disrupts the production and use of goods and services from agriculture to energy production, to tourism, to healthcare. All important sectors of the economy, all important economic activity. It also leads to the degradation of what economists call non-use benefits of natural systems, things that generate aesthetic, spiritual, and existence value. All of this and more leads to economic loss and damage as we degrade these systems, which for the most part are not factored into production, consumption, and investment decisions. And this is what economists call an externality. This is a classic and massive case of an externality, in that decisions are made without being able to fully consider the full cost of the actions that you're taking. Unlike if I buy corn, I know I'm paying for the inputs that the farmer put into the corn and costs that he or she incurred as they moved it to market. That's going to be factored into the price. But often typically these damages are not. And so we make decisions that aren't really economically rational, for that matter, they're rational in the sense that we're making decisions that aren't reflecting the full knowledge of what the costs are to the system. But they undermine they cause economic damage. So it's not uncommon to hear that economics does not care about these non-market effects, but that's not so. There's an entire field of economics that's been around for more than half a century, environmental economics, that's rooted on understanding and developing solutions to environmental problems. In fact, a pioneer in this field was Kenneth Boulding, who happens to be Fuquidine Bill Boulding's father. If you look through any environmental economics journal or course syllabus today, you'll find an inordinate share of the material there relates directly or indirectly to climate change. So what can economics bring to the table on addressing climate change? Some examples include tools, often tools that are developed with natural scientists, to estimate the economic costs of unabated climate change, or put another way, to estimate the benefits of abating climate change, the economic value of reducing the pollution from climate pollution. Economists can design market-based instruments to fix the incentives problem of unpriced externalities. Things such as carbon tax or cap and trade systems or tradable performance standards that put a price on carbon, which leads it to being factored into the economic decisions that I alluded to earlier. Can develop mechanisms to enable more scale and efficiency in the financing of climate solutions. Fortunately, we have a panel of experts today who collectively work across the range of issues I just mentioned. Sarah Sutherland is a lecturer in the Sanford School of Public Policy. She works on various aspects of valuing the economic damages of climate disruption from a natural resource management perspective. Adriano Rampini is a Douglas and Josie Breeden Distinguished Professor of Financial Economics at the Fuqua School of Business. He works on financing the adoption of clean energy technologies. And Emma Raziel is the Richard Y. Lee Professor of the Practice of Economics and Director of the Duke Financial Economics Center. Emma has spearheaded efforts at DFE to develop a series of courses for Duke students in the area of climate, energy, and sustainability finance. Emma is also a Duke alum, having earned her PhD here as well. So now I'm going to turn the microphone, so to speak, over to Sarah, Adriano, and Emma to take it from here, sequence.
Thanks, Brian. Hi. As Brian said, I'm Sarah Sutherland. I am a lecturer in the Sanford School of Public Policy and an environmental economist. I study the distributional effects of natural resource management and environmental policy. I do some work with state and federal agencies to value natural resources and evaluate the policies that we have to manage them. So as an environmental economist, we think a lot about climate change, and more specifically, how does climate change impact economic outcomes? So policymakers, they might come up with some regulation or some policy to mitigate the effects of climate change by, let's say, subsidizing renewable energy or preserving ecosystems that store carbon. And in order to justify the expenditures that go into doing something like subsidizing solar or wind energy, we have to measure the benefits and the costs. And one of the policy evaluation tools that we use, and especially economists use, are cost-benefit analyses. Now, measuring costs of a lot of these different policies is somewhat straightforward. So if we think solar panels, we can estimate, let's say, the cost of providing X solar panels is $60,000 and $500 in labor to install them. But maybe estimating those benefits of having the solar panels that will reduce emissions from the production of electricity, we need a way to estimate what those benefits of reduced emissions are. And so back to what Brian said about using tools, economists and environmental economists more specifically provide tools that allow us to do this. And we can actually estimate the benefit of mitigating climate change. And we come up with this dollar value of keeping 1 ton of CO2 out of the atmosphere. And we call this the social cost of carbon. And that really underlies a lot of the policy evaluation that goes into evaluating different policies and regulations that address climate change. So as Brian said, carbon emitted into the atmosphere causes warming. It leads to climate change, and that impacts economic outcomes. And so this could be through reduced agricultural productivity, lower crop yields, lower yields in fisheries. We can think about sea level rise and coastal property destruction. Labor productivity tends to be lower in the heat. And this is especially true for populations that are more vulnerable to this and that might work outdoors or in areas without air conditioning. And climate change, additionally, will have huge cost in terms of health outcomes. So we know that the increased heat can lead to increased mortality and infectious disease. So economists, with help from other disciplines, estimate what does one additional ton of carbon cost us in terms of all of these different metrics. And we call that the social cost of carbon. And so we estimate it to be about $190 a ton right now. And so it recently went up. But it's very important when working with government agencies and policymakers. So I've used the social cost of carbon to estimate the economic cost of the destruction or loss of seagrass off of the coast of North Carolina. So seagrass, like trees, stores CO2 and sequesters it from the atmosphere. And by destroying the seagrass, that carbon gets released. And so that destruction of the seagrass has an economic cost, and we can use social cost of carbon to figure out what that is. And we can use the social cost of carbon to figure out what is lost from destroying other ecosystems as well, like the rainforest, or perhaps not being proactive about reducing severity of wildfires, which would burn down more trees than if we were to more efficiently treat for that. And so I teach public sector economics as that's my main course. And I teach it both at the undergrad and the master's level. And in teaching that, at the heart of it, we talk a lot about policy evaluation and market failure and externalities, as Brian had mentioned. And so cost-benefit analysis in terms of quantifying the benefits of mitigating climate change is certainly a foundational part of this. And social cost of carbon, thinking about how policies will impact climate change outcomes and how we should take that into account when making investment decisions is also really important. And so also in this context, economists think a lot about the distributional effects of climate change. And so that might have to do with what groups are most affected by climate change. And we might think of those that are more exposed to extreme weather, be it that they work outdoors or they don't have access to technologies that can protect them, like air conditioning. Or we might also think about what groups are going to be most impacted by the policies that will address climate change. And so a lot of the policies that address climate change might involve taxing carbon-intensive goods or things of that nature. And so when we tax goods that certain groups spend more of their income on consuming, there's going to be distributional consequences. So economists don't only think about mitigating future costs, but also how those costs are spread amongst different groups, and that's the distributional aspect of it. And so my work sort of addresses all of this in terms of how we value maintaining natural resources and ecosystems, and it most certainly takes into account how we can quantify the benefits of these in terms of keeping carbon out of the atmosphere. And so very important in the policy realm and figuring out where we're going to invest money.
Great. Thanks, Sarah. Your work has helped underscore the notion that there is value in developing solutions to climate change, and meaning it's worth investing in. So now Adriano is going to talk some about how you can mobilize capital, how you can mobilize capital towards clean tech and climate solutions, and what are some of the challenges that need to be overcome to do that. Adriana?
Thank you, Brian. So thanks very much for the introduction. My name is Adriano Rampini. I'm an economist by training. I have a PhD in economics from Chicago, but I'm not an environmental economist. I'm a financial economist and a macroeconomist. And in some sense, it might be interesting that in fact there's a lot of work now thinking about questions related to climate change across many different aspects of economics. And in fact, the aspects that I'm going to talk about today are obviously related to climate change, but they're really put a financing perspective. So thinking about the financing of clean technology investments center stage. This is in fact some joint work on financing the adoption of clean technology with one of my colleagues here in the economics department at Duke, Andrea Lanteri. And essentially, how did I start to think about this? I've been working a lot thinking about firms and households' incentives to invest in various durable assets that might be more or less durable, and also in the incentives of firms and households to invest in new or older type of capital goods. And this naturally led us to think about the fact that old capital goods are typically different vintages and often require more, are less energy efficient. This then led us to start to think about what are the incentives and what determines the choice between different types of capital that different in their energy efficiency. So how do people choose between clean and dirty technologies? We actually started out by looking at some data. Well, we didn't really start out that way. We started to think about what are the basic mechanisms, but we looked at the data to figure out some stylized facts, and we looked at the data from the global shipping industry. And that is essentially an empirical laboratory. Nothing I will say is specific to the global shipping industry. There's about 100,000 vessels, ships in the world that transport goods, and they're responsible for about 2.5% of the global carbon footprint. Okay, so this is a massive in terms of carbon emissions. We have a cross section of that data and looked at it, and what we found is that when you look by the size of the fleet, you see that small fleets have a much higher carbon intensity than larger fleets. So when you plot a picture of carbon intensity against the size of the fleet, is a steeply downward sloping line. There's two aspects to this. One is when fleets buy, and I think of a fleet as a firm essentially. When you think when fleets buy new ships, the larger fleets invest in cleaner ships, meaning they buy ships that have, for example, an eco engine, whereas the smaller fleets don't do that at all. They actually buy essentially no ships with eco engines, and that's one aspect. And then the other aspect is that the smaller fleets also operate older ships. So whereas larger fleets operate newer ships, and then because of technological change, the newer ships are more energy efficient. Okay, so then of course I'm by training and my work is as a theorist. So a theorist is trying to understand what is the fundamental mechanism that drives this particular pattern, and which in economics we write down a model, and the model essentially is trying to understand. So this choice between clean and dirty technologies. Think of ships, and so the question is, what kind of ship will a particular firm invest in? And by the way, I'm going to talk about firms, but everything I say is really the same for households as well. So the same trade-offs we think apply to households as well. So what does it mean for capital to be clean in the way we think about it? It's essentially just it's going to require less energy to operate. Okay, so well, what that means is, well, if clean capital requires less energy to operate, and we want to think about what is the incentive to buy clean versus dirty, then it must be that clean capital, on the other hand, is more expensive. Because if clean capital were cheaper and would require less energy to operate, well, everybody would operate clean ships, and that wouldn't be interesting to understand the basic choice. So this means clean capital then is, or clean ships are more expensive. So essentially, eco engines are expensive. But of course, on the other hand, it can't be too expensive. If it's massively more expensive, well, then nobody will adopt the eco engines, the clean ships. So it's got to be that it's more expensive, but not too much. And that is then the basic trade-off. So the basic trade-off then in our model, and we think this is important in terms of determining that choice, is that the clean ships are more expensive up front, but then come with lower operating costs, essentially lower energy needs down the road. Now, how does that relate to the cross-section? It relates to the cross-section in that firms that have more limited funds, well, they find the clean technologies, the clean ships, if you want, the upfront investment too high, and choose to operate instead the dirtier ships, which are cheaper upfront, but require more energy down the road. What that means cross-sectionally is that firms with limited funds will on the one hand operate dirtier capital, and on the other hand will be operating a smaller fleet. And the well-capitalized firms will operate larger fleets and operate cleaner technologies. So that then is essentially our basic mechanism that is behind, we think, the basic pattern in the clean technology adoption. So what it means, though, is that there's an endogenous pattern whereby the more financially constrained firms adopt dirty or operate dirtier technologies exactly because of the financing need of adopting the clean technology. This then means that notice that everything I said, nothing I said essentially relied on a externality or a carbon emissions. I think of carbon emissions obviously as being related to energy use. But of course, this means, for example, that when we do policy, and this touches on the distributional consequences that Sarah was talking about. Well, suppose that we do environmental policy and increase the cost of carbon. Well, we should take into account the fact that the more constrained firms, or households for that matter, will be operating on average a more energy intensive capital stock. So there's distributional consequences to environmental policy. I have a few more things to say about operating new versus old, the incentives to operate new versus old technologies, about the effects of financial development on the adoption of technologies and the transition. But let me maybe for now just leave it at this. And if there's questions about the choice between new versus old capital, operating new versus old capital, or financial development, effects of financial development, I'd be happy to comment on them in the Q&A.
Thanks, Adriano. Your comments really, they underscore the notion that capital is going to find its highest valued uses. And you talked about it's going to flow towards whatever the least expensive way is to get the job done, whether it's in shipping or transportation. And that's clearly the case. One of the things that's sort of arisen in the last decade or so, it's really been longer, but in some ways it's been shorter, is the notion that capital might flow also because of where it's perceived to generate positive environmental, social, and governance value, or ESG. And that's become a burgeoning field in finance, sustainability finance. So I wanted to turn to Emma right now, who's, as I mentioned at the beginning, she's helped develop and spearhead new courses at Duke and the Financial Economics Center that have been dealing with issues like ESG. I don't want to necessarily put you on the spot for just ESG, but it's a sort of a segue from capital just finding its own to efforts to kind of direct capital to certain types of outcomes. And so, Emma, if you could speak about what's been going on at DFB and where you see things headed in that program, that'd be great.
Absolutely, Brian. Thank you. Yes, so of the four of us here, I am the least knowledgeable about the topic that we're talking about climate sustainability, climate change. My role, however, is to bring some of the latest thinking and the most important issues in front of our undergrads, who are, as you can imagine, incredibly eager to learn about all these different areas of finance and how they intersect with climate. So everything that Adriana has been talking about, what Sarah has been talking about, and Brian, these are topics that we want to bring to undergraduates because many of them are eager to work in this space. So just to give you a little tasting of the courses that we're now offering, and I'm going to tell you about 4 courses that we've brought in literally just in the last year that we're now teaching to undergrads. And all of them, by the way, are being taught or co-taught by experts who are doing this work in the real world. So this is another key feature of these courses, is to be able to bring in people who are actually doing these different types of finance themselves. And that, of course, has made them even more attractive to our undergrads. So we have a course that's going to be taught for the first time this fall called Investing in Climate Solutions. So this is how do private investment opportunities in climate-friendly ways with venture capital, private equity, private credit, project finance, how do you find these? How do you evaluate these? This course is going to be taught, co-taught this fall actually by a 20-year veteran builder of sustainability market-leading companies. And her colleague is an investor in projects that aim to solve social and environmental problems. And then when we're thinking about portfolio investing, what stock should we invest in? What portfolio should we invest in? Many of our undergrads want to be able to invest in ways that, of course, generate great rates of return, but are also sustainable. They want to invest in companies that are taking sustainability seriously. So this current semester, which is just finishing up, we have had a course called Sustainable Investing, which the students are learning to analyze sustainability practices of individual firms as a component of investment research. So an additional component, if you will, of what are the things we're looking for in a good investment. One of those things needs to be that the practices of that company are sustainable. And this has been taught by a 30-year seasoned financial executive who actually founded and now runs an investment management firm with a focus on sustainability. And he's from the Boston area, and he's been flying down to campus pretty much every week to talk to the students and teach them about this. We have another course that's being taught right now called Climate Change and Financial Markets. And this is a course about things like the financial regulatory structure and its responses to the effect of climate change. So in addition to that, what are different types of equity and debt products that can be helpful in terms of climate change, green investing and so on. One of the instructors works on the capital markets desk of a leading investment bank, and she is in fact the leader in ESG capital markets growth. And she actually chose, because she mostly works remotely, she chose to come and spend part of the semester actually living down here in Durham while teaching this course. And she's been co-teaching that with one of my colleagues, Lee Rayners, who works here with me in Duke Financial Economics and has done a tremendous amount of research on ESG in general and also climate in particular. Casey, you might be noticing here how I keep mentioning that we have these amazing people and they're actually flying in or even coming to stay here. I think we're incredibly fortunate at Duke that this is a very attractive place to come and live or stay or teach or work. And that's what we might call a positive externality of being at Duke, is that people are always very ready to come here and share their expertise with our amazing students. I have a couple of other courses that I want to mention. One that was taught last fall, which was about analyzing or quantitative analysis of ESG reporting. ESG was mentioned earlier. It's this sort of combination of environmental, social, and governance issues that investors are increasingly looking at to see whether the firms that they're investing in are choosing good practices in all of those areas. And one of the things that makes that really hard is it's kind of a moving target. We don't have straightforward metrics for environmental, for social, for governance practices of firms. Some of them are in the process of being developed. Some have barely gotten started. But if we're to be able to teach our students how to analyze firms' behaviors in these areas, the metrics that we use to measure that are going to have to continue developing. And in fact, they are continuing to develop. So this is a really cutting edge course for students that we have who may want to go into investing, or they may want to go into work in social impact, or any of these areas where an understanding of how to analyze firms' behavior is critically important and increasingly so. And then the last couple of courses that I'll mention, I have a colleague here, Chris Wedding at Duke, who is formerly in private equity. He titles himself the Climate Tech CEO Coach, and he advises climate tech companies. And in his non-existent spare time, he also teaches actually several courses at Duke, but the ones that he offers through DFE, one of them relates to ESG investing. It's a different angle on looking at trade-offs between corporate profit and sustainable outcomes in business projects. And he also teaches a course on climate tech startups, which are basically what are strategies that can help startups in the climate tech space succeed as they raise money and build their projects. So I will stop there and turn it back to Brian. Thank you.
Sure. Thanks, Emin. So your voice is warm. I'm going to turn back to you with a question. First, a comment. A number of those classes that you referred to that have real world experts coming and teach, many, if not most, are actually taught by Duke alum. So they're not only do they remember the beautiful campus, but they also have this strong affinity for the university and for the students. One of the things I've known talking with alumni over the years, the thing they were most interested in is the student experience, and you've certainly helped provide for that. The Duke Financial Economics Center is, one of its many successes, and probably its central success has been putting Duke economics graduates on a career pathway. And, you alluded to students are really interested in this, I think, intrinsically. But I think what you've been starting to see the last 5 or 10 years in particular is the demand is really there from firms on Wall Street and elsewhere for this type of expertise. So can you say a little bit more about how this, like what that balance of sort of demand and supply is looking like for these skills?
Absolutely. Yes, it is one of the great things about being able to set up all these courses is that they are, as Brian said, in many cases, not all, but many cases, being taught by Duke alums who have even more reason to come back. What are we seeing on Wall Street in particular? Something that I have been doing for longer than I care to count has been advising Duke undergrads who would like to go and work on Wall Street. I was on Wall Street myself for many years before coming back to Duke. So I have a little bit of sort of insight about what those Wall Street jobs look like. Are we seeing more demand on Wall Street and beyond Wall Street for students who are being educated in this way? Absolutely. Every investment bank now has an internal group that's looking for its own interesting investments in sustainability, whether that's climate tech as an investment, whether that's building software to measure different aspects of sustainability, doing that in-house. It was for a while the case that the investment banks primarily looked to fund other companies that were doing this sort of thing. More and more, the investment banks realize how important it is and how they actually need to bring it in-house. So they're both funding other companies, but they're also bringing this expertise in-house. And the demand then for students who've been exposed to the metrics, who've been exposed to concepts of green bonds and thinking about developing climate tech products that are going to make providing energy cheaper and in a more sustainable way, that absolutely makes them very attractive on Wall Street. It also makes them attractive potentially to private equity firms and venture capital firms who also need eager young students to come and join them and work on projects with them, and students who've had some exposure and speak the language a little bit. That's incredibly attractive because it means those students can hit the ground running.
Great. There's several more that are sort of ESG related, but rather than kind of wear you out, maybe you can actually take a look at the chat and kind of prepare yourself for them. But Sarah, there's a question, actually, the very first question that we had in the chat is related to what you referred to $190 a ton social cost of carbon, whether that's applicable globally or is the USA figure. And so if you can talk about that and the controversy around this issue of who is counted in the social cost of carbon for the purposes of US policy decisions, that would be great.
Yeah. So that's a very interesting question. So this is the figure that the US uses, and we use it for our policy, and we are supposed to be quantifying global impacts. Now, one of the most controversial parts about this is we value in the social cost of carbon and what are the risk to mortality from climate change, right? And so we value the loss of human life. Now, in our estimate, we value the loss of a life in the United States differently than we do in, let's say, the Ukraine or than we do in Bangladesh. And so this is a very controversial take on this. And if we were to value all lives the same, it would be about double that figure. But the social cost of carbon is something to mention is this changes from administration to administration as well. So when Donald Trump was president, he didn't think we should take into account the impacts of climate change globally, because if we were incurring the cost of it domestically, why should we consider global impacts? I think because carbon is a global greenhouse gas and our emissions do affect our global everyone else in the globe. Most people have agree with taking global impacts into our calculation. But this is global impacts that we use in the U.S., but it's a U.S. specific number right now.
I think what's interesting about that too is the way this has been set up, and of course, that when used for public policy decisions in the U.S., the regulatory decisions, it follows that essentially an intergovernmental agency working group that has prepared this report and revised this report on what the social cost of carbon is. And it actually puts it in a table, and it says, if this is your interest or discount rate of interest, pick this number. If you're interested in the impacts just on the United States, pick this number. If you're interested in global, pick that number. So it really gives an administration a lot of discretion about how it's going to deploy the social cost of carbon in its decision-making. And so I do think you just gave an example of one administration using one value and one administration using another value. They didn't do a whole different study. They just picked a different part of the table.
Right.
So, Adriano, I got a question for you. This isn't from the chat. This is just something I was thinking about as you were talking. So what is particularly unique about clean tech or climate tech adoption that motivates your research in this space? Why is it different than communications technology or healthcare, for instance? What is it that sort of makes it not only interesting to you, but you think is really interesting to the market?
I mean, that's a good question. In some sense, it's a basic the basic trade-off is really a basic financing problem. I just think that this particular trade-off is actually very salient in this context and explains a lot of the cross-sectional variation in terms of technology in terms of technology adoption. So essentially, I would say it explains also the patterns. Like, for example, I saw that one of the questions in the chat was about solar panels. So solar panels have been adopted much more by well-off households than by less well-off households. It's particularly controversial in California, for example. And the question is does this suggest that somehow the more well-off people are, let's say, more concerned about the climate, or that in some sense concerns about climate change are a luxury good? And the point of my research is to say that when one thinks about the resource, the problem that households face with limited resources, in the way I think about it, everybody cares the same. Everybody may well care the same about the environment, but nevertheless, you will see that the more financially constrained households will end up being making choices that mean that they are essentially operating, if you want, much less energy efficient households. And I think the same thing is true when we're talking about the US versus the rest of the world. When you think about the technology adoption, you might find that there's technologies that are cheap but considerably dirtier that will be adopted in countries where most people are less well off. And again, not because in substance the people in developing economies care less about the climate, but just because of this financing trade-off. It then also means that, for example, financial development actually can have really positive consequences for the global economy. The interesting aspect there is that it's well understood, has been argued and studied for a long time, that financial development can allow people in less developed economies to invest more, and it enables growth and higher output. But in the context of environmental macroeconomics, this may in fact be a double-edged sword, because more output is also more carbon emissions. And so this has led some people to conclude that maybe financial development, for example, is is not actually something that is particularly desirable because it's going to result in even more carbon emissions. What my work shows essentially is that, well, there's an extra aspect of financial development, which is financial development doesn't just affect how much people can invest, but also in the type of capital that people invest in, so the composition of investment. And in particular, it might very well, the composition of investment as countries develop in terms of the financial markets might shift towards more clean technologies. And so in a best case scenario, then financial development can both increase growth and global living standards, as well as make the economy cleaner and potentially even reduce energy use and hence carbon emissions. So you're right, at some level, the basic trade-offs are actually kind of apply to other investment decisions too. But here, I think it's this in this specific context that I think it's particularly salient and consequentially important for the debate and reflected in a lot of the cross-sectional patterns that we see in the data.
I wanted to pull on one thread about your remarks here. It's sort of like the dynamics of technological change and adoption. And so if you look 10 years ago, and in some cases, maybe even 5 years ago, really, if you looked at adopting solar, whether it's rooftop or utility scale, it was definitely a more expensive alternative. Now what you're seeing, especially utility scale adoption, because certain countries, whatever, and certain municipalities and states and other jurisdictions said, well, we're just going to mandate a certain amount of solar. So we'll take the bite. We'll do the more expensive energy, and we'll be good global citizens. Well, that has caused scale effects that have brought the cost down 85 to 90% in the last decade. Onshore wind is actually the cheapest way to produce electricity in much of the central United States, just because once you build it, it's just very cheap to generate it. And so over time, you're sort of seeing that people right now are benefiting from others sort of taking it on the chin early on, and now it's really changed the dynamics of that pretty considerably. So I don't know if you have any comments on that, but I have some other questions also to turn to Sarah and Emma as well.
Yeah, no, let me just briefly comment this. Absolutely. So this is one of the things that we do, is exactly to think about what happens as you have technological progress. In the way we think about it, it's not really endogenous, but it's essentially. But you're absolutely right. I mean, the basic pattern is still there. It's going to be the people who, even if you do a big push, it's going to be the better capitalized and the communities and probably countries with more financial resources that start out the big push and are the early adopters. But as the price comes down, adoption starts to spread. Absolutely. And in fact, in a best case scenario where it actually even becomes a cheaper or sufficiently cheap, then it might eventually dominate the dirtier technology. But we are actually doing various policy experiments where we're thinking about as you have technological progress, how does the adoption spread? At each point in time, you still have this cross-sectional pattern where it is the currently the households or firms with more resources that will be, if you want, the early adopters at any point in time. But over time, there's a considerable spread of the technology.
Correct. Well, I'm going to turn to another one of the questions from you alluded to this question in the chat about solar panels produced in China. The question says, how do you measure the account economically and ethically for the cost of forced labor to produce in your total equation? There's a related question also about automobiles as well. And so I'm not sure who wants this. I'm going to throw it at you, Sarah, and you can throw it back if you want. Just because you took the source cost carbon on, this is sort of related to that issue, but I also have some thoughts about what this might be tracking. But
my understanding, the question is, how do we take into account these other potential negative things that are happening in production processes in other countries? Is that sort of the...
Yeah, as we green up and if we're getting more of our energy, say, produced in China, and it's being produced by practices that are being called into question, how does that factor in? I mean, I think the simple answer probably for you is it's not in the social cost of carbon, but maybe if you could wipe the slate clean, would you factor it in, and if so, how?
Well, so I would say that, we might call that, this, I guess, another way, a negative externality associated with the production of solar panels. Let's say if there's child labor and that's bad for society in China, in which case, whenever there's a negative externality in the production of a good, what that implies is that we're not paying the true social cost of consuming that good. So if it's the case that we start importing more from China because it's cheaper, well, if we were to have some policy which would tax the good or make it so we don't purchase from places that that use child labor, the price of the good would likely go up, right? And so the consequences for adoption would mean it would slow adoption, because a higher price, just the law of demand says we're going to have less people consuming that good. But it's not necessarily a bad thing, right? So there's these trade-offs and distributional concerns that are also important to take into account.
Maybe I can just add one thing. This is another aspect of this, which is there is in thinking about clean versus dirty technologies, for example. Certainly, taking embedded energy into account is very important, and so it's certainly the case that if it requires a lot of energy to make the clean technology, then that should certainly be accounted for. That, for example, in the choice of in the thinking from the policy perspective about gasoline cars versus electric cars, that might be very important in determining the choice.
I think to some. Sarah would.
Well, I was going to say that there are people who've done the accounting on this, right? Like, once we take into account the rare earth metals we need for these batteries, et cetera, how good are these things actually for the environment? And companies have responded. So now I think it's Tesla, perhaps, it says we're going to make sure that 95% of our batteries come from recycled materials and things like that. And so I would say that it's not something that isn't thought about. Yeah.
Yeah, I mean, I think in a lot of ways this question is really about the externalities associated with globalization, right? So for looking for the cheapest product, whether it's an environmental product or something else, so I think this is, we have time for one more question, and I'm just going to sort of bounce it around to ask all of you what you think. What are the major barriers that prevent policymakers from factoring in and ultimately addressing the negative externalities associated with carbon emissions? Do you want to start with that, Sarah, and just kind of move us through the rest of the group?
Yeah. So I would say a very easy answer is that addressing climate change has high upfront costs, and the benefits are spread throughout time, and people tend to discount benefits in the future. And that would probably be the simplest explanation that is the big obstacle from combating climate change. That in politics.
Emma,
I'll make the point that actually comes back to what Adriana was saying earlier too, which is that it isn't black and white. You can push for the exact example that we had earlier. We can push for more use of solar panels. But then there may be negative externalities from a social perspective of bringing those in because they might be being produced by child labor. So it's not black and white. Every policy decision has nuances. You can't just say, do this thing and move forward. It's way more complex and convoluted than that.
Adriano.
Maybe just a echo a little bit what Sarah was saying, which is there's upfront costs and future benefits, which is kind of a lot of the trade-off that my work has emphasized. There's obviously many obstacles that are there, but the one I can speak most to is this one. I think the extra aspect that's interesting here is that how people discount future benefits much depends on their current economic situation. And I think that is this distributional aspect that's important, that might also be reflected in people who are less well off or people in the developing world essentially being less eager to incur the upfront investment now and more eager to postpone. And that's in some sense that's the margin in some sense that certainly my work has emphasized. But needless to say, there's definitely other obstacles as well.
Yeah, I'll throw in one quick sort of political economy point that is also reflective of our current reality. I mean, just last year, the U.S. passed its largest ever, it's called the Inflation Reduction Act, but it was really a climate and energy bill. $400 billion in expenditures, possibly even more than that. And it was done in a way that is all carrots and not sticks, really. So it was tax credits and incentives and positive incentives. And what it means is that the political resistance to something like that can be dissipated over time. A lot of those investments are going to be made in traditional red states and red parts of red states. And it's going to sort of change the political dynamic, I think, of being able to desirous of sustaining those types of investments and those types of policies over time. So that's the last remark I'll make about that, other than to thank Sarah, Adriano, and Emma so much for your cogent and helpful comments for the group, and hand it back to you, Joe.
Thank you, Brian. And thank you also to our speakers. You all are wonderful. This is an incredibly layered and complex topic. And with the limited amount of time that we're given to cover it, you did an excellent job at giving us things to think about, questions, and little holes that we can keep poking into.